Good day, everyone. Thank you for joining us today and for what we anticipate will be a very engaging and interesting conversation. My name is Milla Craig, and I'm the President and CEO of Millani, a Canadian-based ESG advisory firm. This is our 15th anniversary in business, and we believe that this makes us quite unique in our market, is that we come to this ESG conversation from a capital markets perspective. And in doing so, bring many of the practices I learned in my prior career in institutional equity with some of Canada's largest banks. That is, looking through the noise of the media, the market, etc., and getting to what one really needs to know. And today is no different. We're pleased to be able to bring this discussion and dialogue to our clients, both institutional investors, asset owners, and asset managers, as well as our corporate clients, to understand the changing landscape in the United States of America with respect to ESG. Given we are here to serve as a platform to hear various views and opinions related to ESG, in preparation for this session, we have reached out to you, our audience, to understand the questions that are on your minds. Those questions will form the direction of our conversation today. As such, the views expressed during this event are solely those of the speakers and do not represent those of Millani, its employees, or partners. Today's event is being recorded, and we will be sharing it publicly in the coming weeks on our social media channels. For today's session, all participants are in listen-only mode. However, we welcome and encourage your questions. We anticipate to take those questions closer to the end of the sessions. However, if the questions are flowing and our conversation triggers more questions, we'll be happy to integrate them into our ongoing conversation. And please note that all questions will be anonymous. The goal for today is really to bring insights to help understand what is happening in the US market with respect to ESG and the potential implications for Canadian firms. So without further ado, it's my great pleasure to introduce you to our speakers. Dan Crowley. Dan is a partner at K&L Gates and is based in Washington, D.C. His practice is focused on the public policy issues relating to financial services and capital markets, and he leads the firm's global financial services policy practice. In the decade before joining K&L Gates, he led the government relation efforts in the Investment Company Institute, the NASDAQ stock market, and the National Association of Securities Dealers. Previously, he served for 8 years in the U.S. House of Representatives in increasingly senior staff positions, including General Counsel, Office of the Speaker. Dan was a President George W. Bush appointee at the J.F. Kennedy Center for the Performing Arts. And while Dan doesn't have an office here in Canada specifically, he has great knowledge of the U.S. legal systems, and I believe a great asset to anyone seeking guidance on how to navigate the current market. We also have with us today Robert Eccles, also known as Bob. Bob and I have known each other for probably close to 10 years now, certainly from his days as the chairman of the Sustainability Accounting Standards Board, or SASB. The focus of Bob's work is on how the capital markets can contribute to ensuring a sustainable society for generations to come. Bob was a tenured professor at Harvard Business School and received tenure in 1989. Currently, Bob is a visiting professor of management practice at the Syed Business School, University of Oxford, where he's engaged in research projects focused on corporate purpose, corporate reporting, engagement and stewardship, and private equity. For those who've met Bob, you know that he's a heavy hitter. But recently, in preparing for this session, we've learned that Bob is also not just a heavy hitter, but a heavyweight. So I promised Bob that we'll take a moment before we start our conversation to share some of his latest accomplishments. So what you don't see in those videos, and apologies, Bob, I believe we were going to show the video of you flipping the tractor tires multiple times. So obviously that demonstrates to us just the degree to which Bob is not, as I mentioned, not only a heavy hitter, but a heavyweight in his own right. And thank you both, Bob and Dan, for being here with us today. It's a great pleasure to have you join us for this conversation. So let's get to the topic at hand. As Canadians, we sit north of the 49th, but it's often said when the US gets a cold, we sneeze. As many Canadian businesses have and do business in the US, it's our biggest trading partner. And we see what sometimes looks like a paradox in the US around ESG. On the one hand, there are media headlines discussing a pushback on ESG. Meanwhile, the current administration has been announcing investments in the green economy with the Inflation Reduction Act. We've been reading reports like the one that just came out from Bain and EcoVadis on do ESG efforts create value? Where findings show that companies are getting better returns by integrating ESG over time versus their peers. Our latest investment sentiment study as well, where we have conversations with the Canadian institutional investors in our December-January timeframe, I think on the next slide, we asked investors if in Canada, if the volatility and the pushback in the US market was affecting their approach to ESG. 100% of those investors in the survey, when asked if they had changed their approach, responded no, but that they would be increasing more so their engagement with their investee companies. So this leads to the question, if ESG integration can serve as a mechanism to generate positive returns, why has there been such a strong negative sentiment around it in the US recently? We'd like to cover off where we're at, where we're going, and what's the impact for Canadian investors and issuers. So Bob and Dan, before we get into the discussion, perhaps I would like to ask you some basics. Maybe I'll ask you, how would you define ESG? And Dan, maybe I'll start with you first. Oh, you're muted, Dan.
There we go. Apologies. Can you hear me now?
Yes, we can.
Okay, very good. First of all, I'm very disappointed that we didn't get to watch Bob flipping tires. I've seen the videos before and they're impressive.
I know.
We'll have to come back to that. Maybe you can tag it on at the end of the video. You know, how I define ESG is as that subset of sustainability that matters to investors. It really is quite that simple. And I note in your opening remarks, you were talking about the DE&I agenda and supply chains and employee satisfaction. I think it's really important to recognize that in the United States today, the E is about climate change and really not much else. The S is about human capital and not much else. And the G really is about proxy voting and the way in which institutional investors communicate their policy preferences to management through the annual shareholder meeting proxy voting process. And that's really important to keep in mind because sustainability, of course, is a very broad concept that involves developing enterprise value over time. And ESG is a subset of that broader concept related to valuation metrics for investors. But it's really important to understand when we're going to get into the political dynamic in the US, we're not there yet. We're still on first base in the US.
Bob, do you align with that same definition? Do you have a different definition? And how might that differ from those that seem to be opposed to ESG at this point?
I completely agree with Dan. Let me just say you were right to say that Dan can be helpful to the audience in a practical way. That tire I flip is 550 pounds. I can deadlift 400 pounds. So if the audience wants any training, if they want to take up, tire flipping or deadlifting, I'm at their service. We see it exactly the same way. We wrote about this in that piece you saw when we first started working together, turning down the heat on the ESG debate, separating material risk disclosures from salient political issues. And I think that's where you get the confounding in the United States, where there are different political opinions. I'm a Democrat, Dan's a Republican. will have different approaches to what the role of public policy should be on climate change, on diversity, equity, and inclusion, on managing human capital. But it's investors who determine what the material ESG issues are. That's what SASB was all about. Mm-hmm. And so we're just in complete alignment on this. And what I'm finding, as I meet more and more Republicans, Dan and I have our little, GOP outreach campaign. When you put the political dimension aside and you recognize there's different, political sort of policy, points of view, when it comes to investing, Dan's exactly right. It's those subset of issues that vary by industry, can vary by company strategy, that matter to long-term value creation. That's it. It's the ESG integration that you were referring to earlier on. I should also note, there's critics on the right of ESG, and they give it a particular definition. There's critics on the left, on the other end of the political spectrum, as you know. Those people that I ended up blocking on LinkedIn, right? The sustainability Taliban, they don't like ESG because it's not about making the world a better place. It's only about generating long-term returns for shareholders. And they don't like that, so you've got critics on both extremes who are imputing their own meaning into what ESG was never intended to be from an investor point of view.
I think that's key, is that investor point of view. So maybe we'll talk about what's currently happening in the market so that, our audience can understand. Perhaps we can start with the state legislators. Maybe I'm not sure which of you would like to take this on, but how many bills are, in the works? What's been put into law? There are House hearings happening. How many have occurred? What's more to expect? Perhaps, maybe Dan, maybe I'll start with you if you're okay with that question. Could you just kind of give us a bit of the landscape of what's currently happening within the U.S. market? Oh, and you've muted yourself again, Dan.
So sorry. There's a huge divide between the red states and the blue states, and the anti-ESG efforts really are focused in the red states, and in particular, those red states that have fossil fuel industries. So Texas is probably leading the charge, but Kansas has gotten involved, Kentucky, Wyoming, and others. Florida's passed a bill, Kansas has passed a bill. But there have been a number of letters signed either by the red state AGs or the red state governors to different market participants, typically the biggest asset managers, accusing them of essentially pursuing a social policy agenda at the expense of long-term shareholders. And really, I think that's where they get it wrong. ESG is presented as an either-or proposition. It's either focusing on returns for the shareholders or on ESG issues. Where Bob and I are coming from, though, is that it's very much an and. You focus on sustainability because of the impact to investors over time. And then I think that's the fundamental disconnect between the blue states and the red states, is that the red states are seeing ESG as something other than profit maximization.
If you look at the red states, if the legislation, there's so many bills, it's almost hard to keep track of.
Okay.
And how do you define success? A lot of these bills are running into trouble. I wrote a piece called Death of the Last Triceratops, the ESG culture wars in Wyoming. Highly recommended. People will learn a lot about the Triceratops, a lot of important information. In Wyoming, there was 2 of these anti-ESG bills, and they both failed. There was pushback from the Treasury, from the Retirement Fund, from the Banking Association, from the Business Association, and from the Petroleum Association of Wyoming, because it just didn't make any economic sense. And so I'm thinking, passing a successful bill, okay, great. What that means is you're going to hurt the investment returns of your beneficiaries, like is going to happen in Indiana, to $6.7 billion. And here's the most recent example of what Dan was talking about. I was reading the Wall Street Journal this morning. Here's an op-ed piece by Marlo Oaks of Utah, Treasurer of Utah, Todd Russ of Oklahoma, a historic breach of fiduciary duty. And it's the argument that Dan was giving, is that if you're paying attention to these things, they talk about climate change and social justice, you're violating your fiduciary duty. And they say, and it may hurt returns. Well, they don't have evidence that it's an assertion and that they're being politically motivated. Now, you presented some data that they help returns. Let's be honest, you can slice and dice the numbers however you want. I think the empirical resolution of this isn't going to come clean anytime soon, like any kind of investment analysis. The question is, how do you impute to investors a political motivation? How do you know? How do you know if it's a political motivation? Or they all operate under fiduciary duty. They have to provide returns to their beneficiaries or their clients to their beneficiaries. So, I mean, it's puzzling to me, and it's kind of part, I think, of the polarization in the United States, that this, acronym, which nobody used to know what it was about outside of the investment industry, has become this political football. And you've seen the political football in the Department of Labor ERISA rulings. We did this webinar on that. So I think that kind of the culture war part will rage on for a while. It's good for fundraising, it's political theater. But the people that Dan and I know, and you can speak to this more than I can, when you have the conversations outside of the press and the public eye and fundraising and trying to get votes, kind of people see it the same way. It's about investing.
Bob, if I could just respond to that, because you put your finger right on a key issue, which is the fiduciary duty of the people doing the investing. When Florida directed the treasurer to divest from BlackRock, I thought, gee, that's really strange, because BlackRock's had stellar returns for a period of years. How can they square that with their fiduciary duty? So I looked up the Florida statutes, and it turns out that the Florida treasurer is not a fiduciary to anyone. His job is spelled out in the statute as managing state funds. But had he been a fiduciary, I think the divestment would have been highly problematic. And I think that's the problem that the red state AGs and governors are running into. They're launching these anti-ESG campaigns only to have their state treasurer or comptroller tapping them on the shoulder saying, hey, we can't square that with our fiduciary duties. So I think that's ultimately what it boils down to, is who's making the decisions and why. And so long as they're fiduciaries, we have to defer to their judgment, I think.
And if you look at the Department of Labor rule, and I'm sure this got some press in Canada, so ERISA is 50 years old, duty of loyalty, duty of prudence, that hasn't changed. And a colleague of ours, Tim Doyle of the Bipartisan Policy Center, put on this webinar. And so it kind of forced me to be prepared for it and to read more about it. And he helped me a lot. It's actually fascinating when you look at the political dynamics. So the Obama administration, had their thing on ERISA. Trump comes in, and Dan knows the details on this. I'll let him fill them in. And my crowd, right? My crowd, they all freak out. Oh my God, look at this and that and the other thing. Then Biden comes in and he makes some changes, and the Republicans, they all freak out. Oh my God, ESG, America's going to be destroyed. What is the difference? The difference is the Trump said pecuniary and took out ESG. I'm good with pecuniary because I think ESG material factors are pecuniary. Obama said economically relevant. I'm good with that. They took out material. I don't know why. I'm not so good with that. The language goes like this, and then the political reaction goes like this. It's crazy. I mean, Dan, tell the story about it, because you know what happened under the Trump administration with this ERISA rule.
Well, yeah, as I've said before, I was on the Trump transition team for the first time period. You may remember that after the election, they hit the reset button on the transition and threw everybody that knew anything out of the room as a way to get rid of the never Trumpers. And I think it took them 6 months to recover from that move. But during the brief time that I was there were two top targets. One was the SEC investment advice rule, and the other one was the DOL ESG rule. And they spent 4 years trying to put the toothpaste back into the tube. Finally, in October or November of just before the election, they came out with the revised guidance that came up with this pecuniary standard, which, as Bob points out, is implicit in ERISA anyway. So it's sort of window dressing. But the political reaction, the fact that it was the #1 target for the Trump transition team. They appointed Eugene Scalia Secretary of Labor. He orchestrated through the NEC with Larry Kudlow, derailing the switch from the TSP index that would have given them access to China A shares. By the way, I think they violated their fiduciary duty to me as an iFund investor. I was looking forward to having access to China A shares, which I don't for political reasons. But that's a very good example of what we're talking about here, that the political extent to which people are going to try to undermine what I view as sound investing is really stunning. And it reflects quite frankly, a sea change in the approach of the political parties, right? It was always the Republicans that were the party of business, the party of big government, big corporations. Democrats were the party of big government and the working class man. Now, President Trump is the nominee, hopes to be the nominee for the working class. So you've got this role reversal going on, which is resulting in some of these red state attacks, which are really frustrating because the level of knowledge about capital markets is pathetically low. And it's almost like we have to educate people before we can argue with them on pretty fundamental issues that used to be bedrock republicanism. That's no longer the case. And I think that's a good reason why we're having these discussions.
There's a colleague of ours, Eli Lair, who was the founder and president of something called the R Street Institute, sort of a center-right think tank in DC, who wrote a very nice piece that I should send you, in American Purpose, on how the biggest change under Trump was basically the divorce of the GOP from big business. I mean, that's been a relationship for 150 years, one of the few constant things. I mean, I'm a child of the 60s, and I had a beard and it wasn't gray, and I had a ponytail and it was great, and I can't have one now. My wife won't even let me have a man bun or get a tattoo. If you would have told me that when I was a teenager, that the Democratic Party was going to be defending free markets, against the Republicans, I would have thought I was having a bad flashback or something. I mean, it's this extraordinary sea change, in the politics. And I think it's going to have bigger repercussions than simply on ESG. But I think you need to sort of put it in this broader historical perspective. I want the old GOP back. I mean, it was this hostile takeover by this narcissist, this dangerous narcissist. Like, how the fuck did that happen? I want life to be normal again. I want the GOP. I voted for Charlie Baker twice. I'm a Democrat. I'm a lifelong Democrat. I have no problem voting for Republicans, but they can't be crazies like Trump.
So I guess one of the questions that comes to mind, and we saw it quite frequently, was, again, we have investors and corporates on this call. So what's your sense of the scope of this pushback? Is it just to the investment community, or what are your thoughts about how corporates are being affected by this as well?
Dan,
well, yeah. Why don't I start with that? So early this year, House Financial Services Committee Chairman Patrick McHenry, who, by the way, has not been particularly vocal on ESG issues, did put together a working group, a Republican ESG working group. And in the press release, this is February 3rd, 2003, it starts with, progressives are trying to do with American businesses what they already did to our public education system, using our institutions to force their far left ideology on the American people. Their latest tool in these efforts is environmental, social, and governance proposals. A number of telling things about that latest tool sort of reflects the mindset that this is a new concept conceived by a tree hugger in the wake of AOC's Green New Deal. They have no real conception that these issues have been evolving for 20 years at least. But to them, it's new, it's reactionary, and something that needs to be fought. As these hearings unfold, there will be hearings. There have been probably be Judiciary Committee hearings on antitrust issues. The Oversight Committee had a hearing last week that showcased some of the red state AGs. The Financial Services Committee will be having a hearing. But I hope that the focus of these hearings is on what makes American capital markets the greatest capital markets in the world, the deepest, the biggest, the most liquid. Because to my mind, the fundamentals that have led to the U.S. having something approaching 70% of global capital are what make our markets the best that they can be. And that's what we need to be focused on to try to preserve that. That, to me, is an America First agenda, but the Republicans haven't yet caught up to that way of thinking. And the flip side of that coin, you asked about issuers. Kevin McCarthy is now Speaker. He's my best friend in Congress. I served as his general counsel when he chaired the national YRs. We worked together for a number of years, and I have the opportunity to speak to him fairly frequently. What he's told me is that the number one complaint he gets from issuer CEOs is the proxy voting process and the annual shareholder meeting where they have to contend with activist shareholders. So you've got both pieces, right? The sort of perspective that ESG is really social policy masquerading as a disclosure initiative for the benefit of investors on the one hand, and this concern that is consistently expressed by listed company CEOs about having to deal with activist investors on the other hand. And I think those are the two dynamics that are motivating Republicans on Capitol Hill.
Let me just build a little bit on what Dan said. It's interesting. I mean, I think the point that he raises about proxy voting is right. Because you have some of these proposals that just make no sense, right? From the left. And then you've got them coming in from the right. So it's like, okay, we're going to fight the politicization of investing by inserting our own political views by having our own proposals in the proxy process. So it's like, what's the logic of that? The investors are getting it from both the left and the right. I mean, all this stuff of your, boycotting fossil fuel companies to BlackRock. No, that's so stupid. Look at the data. You aren't. And then you've got my, my super left friends that say, BlackRock's got to divest all of their oil and gas. That doesn't make any sense either. So, and I did this interview with Amy O'Brien and Nuveen. So you've got the pressures on the investors, from the left and from the right. Whereas Dan said, they've got a fiduciary duty. They're trying to earn returns. Most of the pressure in the United States is on the investors because there's a relatively small number, that you can kind of point the gun at, and BlackRock gets the, the most hits, and then it's kind of Vanguard less so because I got it at GFAN, State Street, and Fidelity. In the end, what are the companies doing, right? So what I see in the investment community, all these kind of attacks, that are going on them, it's kind of taking up time and it's a little aggravating. Is it changing fundamentally how they're managing? It's probably the same data that you presented in Canada. It's not changing. On the company side, they talk about green hushing. Maybe they'd be a little bit more quiet. Maybe that's good. Maybe they're going to be a little bit more authentic. There's been a lot of greenwashing in both the investment community and the corporate community. So in some ways, this ESG pushback, if we kind of is dealt with in a constructive way in House hearings, I think can be positive. Let me tell you a story of a company, one of my favorite companies called NextEra Energy. It's located in Juneau, Florida. It's the 6th largest capital allocator in the United States. NextEra Energy qualified for the Bridgepoint America First Fund MAGA. It qualified for MAGA. Vote your Republican values. You had to give a bunch of money to Republican PACs and Republicans to qualify for MAGA. Okay, look this company up. Homepage of their website. Leading America to its net zero future. 6th largest capital allocator around dealing with climate change. Incredibly profitable. Published their EEO1C report on DE&I. Have scope 1 and 2 targets, for 2040 or 2050. So there's this disconnect between this rhetoric that's out there. They said, if you want to beat up on a company in the House hearings, call in NextEra Energy. They're not going to change. The big oil and gas companies, you can argue about whether they should be doing more. Same thing. And so I just think eventually what's going to happen, the sort of problems in the red states, I don't think investor behavior is going to change fundamentally. I don't think corporate behavior is going to change fundamentally. I think everybody's going to be a little bit more careful about their claims. But is all of this political theater going to change what companies and investors are doing? I don't think so, because I think the institutions are pretty strong here. And I think where it is going to have a bite, and it's unfortunate and ironic, it's going to be in these red states. They're not going to pass any national legislation. They want to go screw up their own red state. I guess that's their business. I hope they don't, but I don't have any control over that.
What do you think, or do you feel that there will be this level of pushback that we've seen, or that, the media level? We certainly see it here in Canada. There's lots of questions around it. What do you think the implication will be in other jurisdictions? So, as Canadian investors or Canadian corporates, is this something that we need to be concerned about, kind of crossing the border and into Canadian culture or into Canadian investment approaches? Do you have a sense?
I mean, I think probably the reaction in Canada and Europe should be largely schadenfreude. I mean, glad it's happening to you and not to me. I don't see how this is going to. I think Canadian companies that are operating here, I think Canadian asset managers that are managing any, pension fund money from, which I don't think there's a lot of from red states. I mean, there's issues you have to deal with. You don't have the polarization in Canada. I mean, if you look at where this ESG thing could kind of feed into places outside the United States, I think, and Dan's more expert on this than I am, I think you need to have sort of baseline polarization. You've got it here, you've got it in Brazil, you've got it in the UK. Those are the three major markets that I look at. So without that kind of underlying political polarization, I just don't see this ESG thing becoming such a big deal. Dan, what do you think?
No, I mean, once you strip away the politics, I mean, that's the interesting thing here is that, we're having a discussion about the politics around ESG, which are not helpful and are, really focused on this sort of macro power struggle between the forces of Marxism and capitalism globally. But if you strip all that away and just talk about what are the material risk factors that are necessary for investors to allocate scarce capital, you end up with a method of operation that is portable across jurisdictions, right? So if you're compliant with the EU regime, you're going to be fine operating in the US, right? The question now is, how do we end up with some sort of substituted compliance or mutual recognition, given where the US is and the rest of the world? And I think that's a big hurdle that we're going to have to catch up to. Now, of course, the Europeans, some would argue, have gone too far too fast. They issued a bunch of mandates where they don't even have the data yet. And so we have, in the US, there's been concern about greenwashing, which is funds and other companies making claims about ESG that are difficult to substantiate. In Europe, you have the opposite, which is brownwashing, where they all hope to be green funds in accordance with the disclosure categories, but because the data doesn't exist, the CSRD has not gone online, they have to downgrade from category 9 to category 8 or whatever the categorizations are in what we're calling brownwashing. So it's sort of the other end of the same dynamic. But I think if from the investor perspective, and by that I mean the fiduciary perspective, focusing on what disclosures are necessary. And by the way, Bob pointed out earlier that the sustainability Taliban has no limit to the amount of disclosure that they want. But US SEC Chair Mary Jo White at the time had a really good way of phrasing it. She said, sustainability is about what investors need to know, not necessarily what they want to know. And that, I think, is the essence of materiality, is what do they need to have? And if they need to have it, then it ought to be disclosed. But that's a very simple concept that goes back in the US capital markets to 1933 with the Securities Act, and then the 1934 Securities Exchange Act. Our entire corporate disclosure system is based on this notion that investors require enough transparency to be able to make informed decisions about the allocation of scarce capital. That goes back to the beginning. And as long as we're continuing on that path with sustainability, the answers become quite obvious. And the path for both investors and issuers is obvious too, because from the issuer perspective, it's first and foremost an investor relations task. And that pressure, that desire for more granular disclosure of material risk factors is going to continue regardless of what governments do. The markets will continue to evolve, investors will continue to clamor for more information. And my contention is that the regulators, particularly in the US, but also in Europe, are really playing catch up to where the marketplace is, where the investors are. And certainly issuers will have to come into compliance with whatever the respective regimes are. But to my way of thinking, if you comply with the highest bar, you're covered globally. And right now, that highest bar is in Europe.
We talk a little bit about disclosure to build on what Dan is saying, but first, is it okay if I whine a little bit? Milla, can I whine a little bit? So here's Dan and I, with our bipartisan GOP outreach campaign, we write stuff, and I wrote something with this guy, Tim Doyle. We submit it to the Wall Street Journal and all these major publications. No luck, right? So, Marlo Oakes and Todd Rusk get major feature in the Wall Street Journal. Vivek Ramaswamy say something stupid and outrageous and outlandish on either side, get a lot of press. We're going, oh, materiality, fiduciary duty, ESG integration, duty of loyalty, duty of prudence. Like, oh man, that's so boring. We don't want to hear about that shit. So trying to, find kind of mind share when you've got these other extremes playing to the crowd is hard. We're going to keep plugging away. I think this disclosure thing is important. I mean, Dan is right. People expect too much from disclosure. So what you see with EFRAG, I mean, Canadian companies should be more worried about EFRAG than what's going on in the United States. I think most of them don't know what's going to hit them. And you can see even in the EU, they're starting to pull back and it's 25% less. And they've told the, EFRAG people, don't do the sector specific stuff. I mean, I know all this inside gossip, right? What you want to have is the ISSB is going to be the baseline, and kudos to Canada for being a major supporter. That'll be basically the voluntary kind of fallback that U.S. companies will use if you're complying with ISSB. You'd probably be fine with the SEC because I don't think Scope 3 is going to last, as my guess, and I'm actually fine with that, which shocks some of my liberal friends. You want a global baseline and adjusted by jurisdiction. If you can get a global baseline for the investor materiality stuff, which my Taliban people don't like because it's not double materiality, it's not contextual materiality, they can go pound sand. That will be an enormous step forward. And it'll take time. You've got to have it audited. You get the data. Then investors are going to have this material relevant information. But just because companies are reporting on something isn't going to change behavior. That's what EFRAG is trying to do. In some ways, EFRAG is social policy. So even if it's not material, you're going to have to report on it. They've kind of backed off on it a little bit. It's going to be a giant compliance exercise. I mean, unless it's related to strategy, it's less related to capital allocation, value creation, incentives are tied to it, and there's targets and accountability. Simply making companies report on stuff isn't going to change behavior. And I think, the point that Dan made from the previous SEC commissioner on, what they need to know, not what they want to know, that's really important. And that's kind of the fight within the United States, right? Over this SEC rule. I mean, there's people that are the climate change deniers and they say none of this stuff matters. There's people that say that's relevant, but there's language. If you carefully read that 510-page document, there's language in there that I've got to say, it sounded a little bit like social policy, and there's levels of granularity. Zip code, what? 1% materiality for every line item in the financial statements. What? Where did that come from? It makes no sense.
So are we saying, are you saying at this point that this is really about materiality? We hear that clear. I mean, we've been a major supporter of SASB and the focus on materiality for years. But we are starting to see, and seeing engagements as well, to work on this double materiality assessment with a view to understanding how there is the impact on the business as much as the business's impact on the society and environment. Are you dismissing that completely, or am I understanding that we're, what we're looking for right now is a baseline, and then this is sort of next tier, where the markets are going? Dan, Bob,
go ahead, Dan.
What do you sense?
Let me just say, I first of all, I couldn't agree more with Bob on the need for a private sector solution. I don't think this is something that governments are going to be able to get together around the table and agree on some harmonized, standardized global regulatory framework for sustainability. I don't think we're going to get there. I do think that ISSB presents probably the best of the various things that are out there, TCFD and so forth and so on. But I wanted to point out that we had our partner retreat in Arizona a week ago, so I got to spend time with colleagues from all over the world, and I had a lot of time with our European colleagues, and it's really amazing to me the extent to which they don't understand the American perspective on ESG at all. They sort of think we're kind of dumb, because it's so obvious to them. And then, of course, I flipped the tables on them and had a good discussion about the Second Amendment, which they don't understand as well either. But I think that, it's important to remember that the Europeans have rushed forward with mandates without data. So, for example, a lot of us in the U.S. are waiting for the SEC to issue the human capital rulemaking proposal. It's been in the works. There was a petition probably 10 years ago where we've been working on, disclosure of board composition, employee demographics, pay ratios, all those sorts of issues. And the SEC has not yet released it. We're hopeful. We keep hearing it's next month. We've been hearing that for a year and a half. But in Europe, they're going to have a lot more difficulty collecting the S factors because of GDPR, which prohibits employers from asking questions about ethnicity and things like that. So you've got another example of a mandate without the data to back it up. So to the extent that the SEC is dragging their feet a little bit, I think part of it is making sure that issuers are able to comply with the rules as they come online. But the most important thing from the SEC perspective, of course, is surviving judicial scrutiny. And in the wake of EPA versus West Virginia, which reinforced this delegation doctrine, meaning that Congress has to specify in the statute what the extent of the discretion of the agency implementing the law. And it's very clear to me that the SEC has statutory authority to promulgate disclosures, as we've talked about, going back to the 33 and 34 Act, the 40 Act, and so forth and so on. They do not and have not been granted authority by Congress to establish social policy. And so getting into climate change per se, as opposed to disclosure of material risk factors associated with climate change that investors need to have, that scope 3 probably goes too far from the standpoint of what the SEC's statutory delegation from Congress is. And that's probably why they're going to set aside scope 3 or revisit it in some way. They might repropose it, repackage it. But that creates the dynamic with the Europeans where they have this concept of double materiality that's baked in. Without scope 3, we don't even get close to that. And so now the concern is that the Europeans have said if the SEC jettisons scope 3 greenhouse gas emissions, we won't have regulatory regimes of mutual dignity, and therefore we can't have mutual recognition or substituted compliance. So the SEC was dragging their feet in order to dot the I's and cross the T's to survive court review. Now I think they're very much trying to find a way to bridge the gap between where they're likely to end up and where the Europeans are. So we'll see how that plays out, but they're never likely to agree, and therefore the markets are going to have to come up with that gap to bridge the gap. And similarly, and Bob made this point, and I'll just double down on it, which is, there's no amount of disclosure that's sufficient to move the needle meaningfully on greenhouse gas emissions, climate change. It's just there isn't enough disclosure out there. What would work is harnessing macroeconomic forces through some sort of carbon pricing mechanism, carbon tax, and that sort of thing. And of course, when we get there, and we've started to see it in Europe with the border adjustment mechanism, and others are starting to talk about it, but all the people that question whether these disclosures are material, I think, are going to have to rethink that if we get into an environment where there's a price on carbon, which is the essence of materiality when there's a pricing mechanism.
The pricing mechanism point that Dan raises is absolutely fundamental. And I'll answer your question about the impact of the companies on society, the double materiality. I should note that you've got the GRI with a memorandum of understanding with the ISSB, and things can shift, dynamic materiality. Climate wasn't always something people considered to be material 50 years ago. So these things can change, and companies have obligations to other stakeholders. The question then remains, to what extent can a company be addressing issues that are important to stakeholders in a value creation context? And this may be unpleasant for some people to hear, but if they can't, they can't, because they've got a duty to those corporations' long-term survival, not just to the shareholders. I think a fundamental issue, you put aside all the kind of crazy stuff, fair point to raise, is there's been this narrative for a long time. The public sector is all screwed up. Private sector's got to step it up. It's got to do more. That's the phrase you hear. Corporate community's got to do more. Investment community's got to do more. GFAN's got to do more. I'm not 100% convinced on GFANs. It's like Holy Scripture in my crowd, and it's like Satan, in Dan's crowd. It's like, gee, can't we maybe talk about it? I think nuclear is good. No, I can't talk about that with my friends. Maybe we need more. No, I can't talk about having more gas run. Get down to the issues. When externalities get priced, there was a bill that was passed in the House. There's another colleague of ours, Rich Powell, I was communicating with. Republican guy, center right, runs this NGO called ClearPath. This bill gets passed. I support Union of Concerned Scientists and EDF. I get these emails. It's like the crazy emails that my friends on the right send me. They get, hollering about my crowd. Oh my God, this bill got passed. America's going to be destroyed. The cities are going to be polluted. Send money, call your congressman. I kind of look at the bill. I mean, man, I'm not a climate expert. It doesn't look that bad to me. So I talked to Rich. Rich goes, yeah, it's really funny. Everybody in the clean energy industry liked this bill. most of the people in the clean energy industry are Democrats. These are entrepreneurs that are Democrats. But because it's a Republican bill, almost by definition, the Democrats don't like it. And so how do we kind of get beyond that? Focus on the issues, focus on climate, focus on inequality, but don't expect the markets, don't expect the corporate community and the investment community to do things that it's not designed to do. And that's the original argument that Dan and I were making. What are the material issues? What are salient political issues? Separate the two. Then let's have, the public policy debate, and there will be different views on how to address it. But that'll be much more constructive than kind of confounding public policy stuff with material stuff for investors and these stupid ESG culture wars we're having. I saw one of the questions. Look, this is going to last at least through the election. We'll see what happens. I'm not even sure there's going to be a lot of energy for the ESG culture wars, even if DeSantis or Trump wins. It's like, okay, you'd have taken your best shots. You've hurt in your own states if you pass this legislation. There's nothing in the antitrust stuff. Duty of loyalty and duty of prudence hasn't changed in ERISA. There's a bill in the House and the Senate, the Mandatory Materiality Requirements Act, introduced by Republicans. I've read the bill. It's 4 pages long. It's fine. Doesn't say anything new to me. It's all the stuff that Dan was talking about, but sure, go ahead and pass that bill a bit if you want to make you feel better. I can guarantee you that bill's going to come in. None of the Democrats are going to like it, even though it's completely consistent with the whole history we've had of the SEC. It's like, give me a break. It's crazy.
Dan, what's your thoughts? One of the questions that's come up here is, do you think that things will calm down after the next election? Or alternatively, do you think that we'll be seeing more debates around ESG investing and more ESG bans between now and the next election?
Oh, yeah, I think things are going to get worse before they get better. But, again, the other thing we haven't mentioned is that there is a temporal dimension in materiality. That means long-term investors like pension funds are focused on materiality over 40 years, not the next calendar quarter or the next 3 to 5 years, as most investors are thinking in sort of 3 to 5 year time frame. Where climate change may or may not be that significant, but over 40 years, I don't know anybody that's saying that's not significant over a 40-year investment horizon. So I think that temporal dimension is worth emphasizing. But I don't want to shock Bob, but Donald Trump is the front runner for the Republican nomination, and based on today's polls, he's most likely to be the next U.S. president. So I've started thinking about what our approach will be in a Trump term 2. And I think that the answer is that we have to focus on an America First agenda, as he is, right? This populist nationalism that's propelled him. It's the same dynamic as Brexit, by the way. And you made the point about UK, so we'll have to come back to that. And, the ESG debate over there is sort of running in parallel with the US for the same sort of political reasons. But if President Trump gets reelected, the sustainability crowd is going to have to revise their rhetoric, right? And so I've been working on an America First agenda, which is based on what makes our capital markets the best in the world. And I think going back to my days at NASDAQ when I first met Bob more than 20 years ago, we had done a study on why U.S. capital markets result in IPOs in a way that didn't exist anywhere else in the world at the time. And it came down to 4 variables, right? Private property rights, which is sort of the essence of capitalism, the legal system that allows for enforcement of those private property rights, public policies that incentivize innovation in places like, Silicon Valley, Austin, Boston, Massachusetts. And the final thing is transparency, the fact that we have transparent capital markets where investors can rely on the information that they have. And by the way, all of the reforms that have resulted from past scandals, all in one way or another relate to investors getting screwed because they didn't have access to information that management had, right? This is not an exercise in making up data points for investors. This is disclosing material facts known by management in time for investors to take meaningful action. Enron, WorldCom, Silicon Valley Bank all shared the same fundamental problem, which is that management was aware of material risk factors that were not being disclosed to investors in time for investors to avoid taking a bath. So I'm going to work with you on that, Bob, and refine it, and we'll see how the presidential political cycle plays out. But I do think it's worth refining the rhetoric to adopt it to sort of the Republican worldview, which is this anti-Marxist, America first focus. And the arguments all still work, because what we're talking about fundamentally is free market capitalism. And that's what gets missed in the political debate.
I mean, I have to say, I haven't seen those polls, but I'll have bigger worries than ESG if Trump is our next president. I'll be worried about our democracy, but we'll have to cross that bridge when we get to it. But I think the language issue that you raise is important. When you talk about climate change, it can be problematic. When you talk about energy security, you talk about energy transition. If you look at companies like ExxonMobil, how they talk about it, again, there may be different views on kind of what the right public policy approach is, but I think if you could get, a price on carbon, as Dan was talking about, that would sort of, be a game changer in a lot of ways. I think the IRA has been an important game changer. There's an irony in that. Europe's complaining about the United States isn't doing anything about climate change, and we passed the IRA. Another irony, 80% of the benefits go to the red states. None of the Republicans voted for it, whatever. And then Europe saying this is unfair competitive advantage. You're subsidizing your industries and stuff. It's like, give me a break. I think that's right, and this is, some conversations we've had with former leaders, in the House, that the language of how you talk about is important. That, is the point I was making about GFANs. When you look at some of the language, we're going to sort of, solve these problems for the world. No, that's not your job, and if you can kind of get people, but again, it's that, okay, here we're going to be sort of in this pragmatic middle, and it's easier to get attention by hollering with the other Taliban and the flat earthers. So how do we build this bipartisan consensus to use language that's going to be, compatible, makes sense, fits with fiduciary duty and materiality, and move forward? And I think that's the only way the progress gets made. I mean, you made an important point to me, Dan, once when you said you've got a Congress that's as divided as we are now, kind of just a little bit the Democrats have the Senate, a little bit the Republicans have got the House. The only way you make progress is something that's bipartisan, and China's an example of that. And I wish, energy transition were an example of that. And all this ESG, brouhaha, it's kind of like noise that's a little bit frustrating in the short term. A long term, 10 years from now, even 5 years from now, will have this kind of changed the needle on anything? I don't think so.
I think the new normal, is going to be sustainability disclosures. I mean, all the corporate issuers are moving in that direction already. The problem for investors is that it's not standardized or comparable. So we've got all of the essential ingredients, but the only thing it takes now, I think, is time. And again, that's going to continue to evolve almost regardless of what governments do.
So with that, I see our time is almost up. And with that, I think I'd like to just ask one last question to both of you. And it would be to a piece of advice, if there is a piece of advice that you might share to a Canadian issuer or to a Canadian investor as they look at, trying to navigate this political divide that both of you have done such a great job of explaining to us this morning. What would that one piece of advice be to perhaps each? Dan, I'll start with you.
Yeah, sure. The best advice I have, it's sort of like investing, right? Ignore the noise, focus on the fundamentals. When it comes to sustainability and making disclosures, just stick to your knitting, focus on the fiduciary duties, the duty to shareholders. And, I think that the, sound business management practices will suggest themselves. They ought to be taught in every business school in the world. But I think as long as management is focusing on their responsibilities to their shareholders and other stakeholders, that means they're going to be making more and more disclosures. And I get back to where Bob made the very good point that what is needed now more than anything else is a set of standards that allow for comparability by investors. So my basic advice is stick to your knitting and keep moving forward and let the politics catch up to where the marketplace is.
Bob?
I agree with Dan. I think, on the company side, companies still don't do a very good job, in my view, of explaining what they think the material issues are and how they're related to value creation from either a risk or an opportunity point of view. They need to be more explicit about that. They need to acknowledge trade-offs, which companies are loath to do. You can't kind of do everything. Sometimes environmental things and social things are traded off. I think the role of the CSO is changing. I've got a piece coming out on HBR next month. I think that'll be important, where it kind of goes from more, and I'll overstate it a little bit, sort of CSR, public relations, satisfy all the stakeholders, to, it's integrating, as Dan was talking about. What are the material sustainability issues that affect strategy, affect capital allocation? So I think on the corporate side, there needs to be more discipline and not just kind of this corporate citizenship, we're not kind of nice people, so please don't be mad at us. On the investor side, it's the same thing. Don't overclaim these funds you're selling. Don't go sell an ESG integration fund as, saving the world from climate change. Be clear about the difference between ESG integration, and kind of an impact fund. Same thing with companies, ESG integration versus positive and negative externalities. I'll tell you a short story and I'll wrap it up here. I was at a lunch in New York last month, a couple months ago, and a bunch of investors, and I'm talking to these guys afterwards, and I go, oh, so they're like 50 billion, active equities, long only. I go, do you manage any money from red states? They go, yeah. I said, how many? They said, we don't know, but we couldn't tell you if we did. I said, that's great. Are they coming to talk to you? And they said, yeah. And I said, well, how's it going? And they say, well, we sit down with them, explain we've been using SASB, from the beginning, and these are the mature risk factors, and here's how they take them into account. And they're fine. They said, we're actually having more problem with our European clients who are coming to us and telling us that in our general funds, they don't want to invest in them if we've got companies in those funds that haven't made, sort of given a stated corporate target, for climate emissions reduction. And it's like, well, that's not your call, right? I mean, if the investor thinks whether or not a company having a commitment, for some target for carbon emissions, if they think that's a material thing or not, that's up to them to decide. It's not up to you to say, this is what your investment decision needs to be. And so I think same thing, stick to your knitting on the investor side, which I think they're doing. And, let me just say one last thing, this is all going to blow over at some point. I have a codependency on what all these red states are doing. Like, it gives me the opportunity to write all these snarky little pieces that I send around to Dan and my friends. And so when these guys aren't doing this stuff anymore, what am I going to do? What am I going to do with my time? Dan and I will write stuff. We won't be able to get it published in the Wall Street Journal because it's so sensible and pragmatic. Man, I'm going to do? I'm going to flip more tires. And I'm going to do more deadlifting, because that is my core competence. And I'm 72. And, I got to focus on what's important now in the years I've got left. Right, Milla?
Absolutely, Bob. And we're going to show your other video of the tire flipping.
550 pounds, whatever that translates into kilos.
For those who are interested, here's Bob.
A big tire.
Yeah, very impressive, Bob. We'll just take a moment and demonstrate this. And I think it was a set of 4, if I had that correct, Bob? 5.
I did 4 sets of 5 flips. I need to work on my technique. I haven't learned like the drive with my right knee. So I need to move it up faster. I was working on my technique yesterday, because I can always get it over, but it's a little bit sloppy. And I should say to the audience, Jean-Claude Caron, a French Canadian, has the world record, 1,350 pounds, 4 flips in 3 minutes. So shout out to the Canadians. You own the world record in the tire flip. Not bad. You should look that guy up.
Well, I think we can all conclude today's conversation by recognizing that Bob's not the only heavyweight in this conversation. I want to thank both of you. Thank you, Bob, for helping arrange this. Thank you, Dan, very much for the conversation today. Thank you in the audience for your interest in the conversation. Thanks for providing your questions in advance and for your engagement. I really truly appreciate Bob and Dan, you making the time for this conversation. I think it's incredibly valuable for Canadians to understand that perspective from an American. The recording will be made available. We'll be sharing it with you, as I mentioned, in the coming week or two. We will welcome and share that you share that within your networks as well. Should you have any additional questions or inquiries, please feel free to reach out to any of us on our team here at Millani, And with that, I wish you a wonderful day.
Cheers, bye.